What's going on, everybody? Welcome back to another video. What a crazy couple of days that we've had in the markets here. We've had a lot of volatility, some incredibly important inflation data coming out with CPI today, coming in a lot lower than expectations. And we have Tom Lee coming out, giving us even more insight into where he thinks the market is headed next and the exact reasons as to why. Now, he has brought up two incredibly important points and things that he's looking at in order to draw these types of conclusions. Now, I'm going to be breaking down exactly what he means by these things in this video here because, again, guys, understanding this type of information is incredibly important to having long-term success in the market because, again, information is one of the best edges that the market has to offer. So, guys, before we get into all of that information in this clip here from Tom Lee, if you guys do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot spreading these videos out to as many people who actually want to learn. Let's try and get this one to 500 likes, guys. That would be pretty awesome. And if you never want to miss another video like this, make sure you hit that subscribe button and turn on notifications. But without further ado, let's get right into it.
Broad market have a 4% decline in valuations. To us, it really looked like a lot of liquidation. I think investors are, of course, reacting to the White House warning of pain ahead, but it has been more of an equity sell-off than it has been in corporate bonds. So to us, 4% down days, I think it's an overreaction.
Yeah, how do you best explain that difference between what equities have done and what we've seen in IG and even high yield?
Well, I think on the stock side, markets are now saying, look, the new regime is we have to take the tariffs seriously. Now we don't know how long these tariffs might be. Will it hurt growth? And we've seen cuts from economists. But the bond market is saying, well, you know what? This is a growth scare. But the Fed is also now in a position to begin cutting because inflation pressures are abating. So I think the bond market is sort of pricing in a Fed put. The stock market saying, I'm not sure if there's a White House put, and then the Fed's on hold, and I think that's the divergence.
So which one should we be listening to?
Well, I think the Fed put, in fact, is probably coming back because the odds of a May cut have been inching up. They hit 54% yesterday.
Now, if you guys were paying attention closely to that clip, Tom Lee told you guys the two most important things that he is looking at to make his projections about the market moving forward. Now, a lot of you guys might be watching some of these Tom Lee interviews, the monthly webinar that he put out today, and some of these other YouTube videos out on the internet, and you probably aren't getting much from them. They're saying, oh, Tom Lee says this, the market's going to go up, here's the chart. But in order to really understand kind of what could really happen next, you have to understand the reasons why these really successful analysts are talking about the market in the ways that they are. Now, the two things that Tom Lee is using right now is the relationship between the equity market and corporate debt, so government bonds, and also this concept of the Fed put coming back, the White House put, and the economic put. Now, that might seem like a complicated concept, and for those of you guys that are new, you might be asking yourselves, oh my God, is the White House going to start trading zero-day to expiration options in order to clear all of our government debt? No, but that would be pretty interesting if they did. All that means, guys, is when they talk about the Fed put, it's the Fed coming in to basically backstop the market in the economy. And the White House put would be the White House taking actions to either backstop the market, which they've said they're not going to do, or the economy, which they easily could do. So understanding these things, guys, is incredibly important. And when we think about kind of some of the reasons why the market is so volatile right now, obviously everybody is going to cite tariffs. And while those are important and definitely a factor weighing down on markets right now, there is something else happening that all of you guys need to understand. We're going to talk about that a little bit later in the video with some data points that are probably going to blow your mind and I don't think you guys have seen. So, but first I want to talk about this relationship here between the equity markets and corporate debt. So equity is a cushion against default in the capital structure. When there is stress in equities, it impacts credit at the margin. This is the most important part. When equities are weak, but credit is not, meaning that the stock market is selling off, but corporate debt isn't, it's usually a sign of overreaction on the part of equity markets. Here's one way we measure it. So what they're effectively saying here is that if a lot of what's happening in the market right now is not scaring a lot of these investors out of the bond market, that is a sign that the equity market might be wildly overreacting. And every single one of these green arrows that you see on the chart here is a reflection of that. And you can see now that equities are significantly underperforming the corporate bond market. Now, as Tom Lee said in the monthly webinar today, this could be used as a tactical buying opportunity for some of you mid to long-term investors. But again, guys, I don't want you guys to look at this chart and use one data point and say, oh, correlation does equal causation, the market is about to rip. You got to take all of these metrics with a grain of salt, but seeing as though the markets have significantly moved to the downside, again, it could be a little bit of a good opportunity here to start maybe dipping your toe back in. But what I really want to talk about with you guys here is a lot of people are talking about tariffs being the main and only reason why the markets are witnessing a lot of this new volatility. And I quite honestly disagree with that. The first thing that I want to talk about here is, again, I'm going to throw up this screenshot I've got from Tom Lee's monthly webinar today. Stocks versus bonds, meaning equities down versus corporate bonds, which we just talked about. Stocks reacting to uncertainty of tariff wars or trade wars, plus Doge and the resulting fallout on the economy. The White House says there is no equity put, meaning that the White House is not going to come and step up to backstop the stock market if it continues to fall even more, which, I mean, it could be just words. We did see Donald Trump come out and say that he was going to buy a Tesla because, again, Tesla was tanking very significantly. But there is an economy put, which we haven't necessarily seen the actions they're going to take on that side yet. But what they're effectively saying is that if business activity and growth really starts to slow, they are going to step up to support the real economy. And you're going to see the reasons why they're doing this in a minute here, but just stick with me for a second. Bonds see a Fed put coming into play. When we think about the Fed put, what it really means is that the Fed might start coming out and talking about talking about the markets and the economy in a little bit more of a dovish sense. Remember, we got that hawkish cut back in December, and we've seen a significant amount of volatility ever since. If they start coming out and saying, okay, we were kind of expecting to cut rates a little bit later in the year, and we weren't really thinking we were going to have to cut rates as much. And now they start to come out and say, well, actually, we might actually want to cut rates a little bit sooner, and we might have more rate cuts coming this year. The markets will most likely love that. Now, this is something that I've talked about a lot, that a lot of this money is flowing out of the U.S. markets into other markets. You're seeing a lot of money just kind of fly into cash there with a lot of the sell-off that we've seen. If we get that type of Fed put in the market here, the markets or all of this money sitting on the sidelines could easily start coming back in. But I want to bring your guys' attention over here. We're going to take a look at that second, but I was tweeting out a couple of, in my opinion, very, very important things today that I don't think a lot of people are paying attention to or fully grasp. And this is, I would say, at least 50-50 why the markets are so volatile right now. Yes, we have talked about the potential effects of growth and GDP due to this tariff and trade wars, depending on how significant the retaliations are from a lot of these other countries and regions. But this is one of the most important things here, guys. The bumpy global shift to market-led growth. In 2024, the U.S. had never been more government dependent for 85% of job growth. Do you guys realize how insane that is? That 85% of all job growth last year was in the government sector? That's crazy. And 33% of all spending. Now, remember, about 33%, it varies a little bit every single year, but about 30% of GDP does come from government spending. So I want you to think big picture here for a second. In all the administrations in the years prior, we've seen everybody continue the high levels of debt, the high levels of spending, the high levels of government hiring that all of the administrations have continued before them. Now, we are starting to see an administration that so far is sticking to their guns and saying, yeah, we really want to cut spending. Not only are we not going to be hiring new government workers, we're going to be firing a significant amount of government workers. And that can have a significant drag on non-farm payrolls and can also increase the unemployment rate. And on the government spending side, if you don't have that crutch or the backstop of the U.S. government to spend all of this money and continue boosting GDP, well, I said this on the private live stream today. It's like somebody was walking around with a big and really good fat suit on. And you're like, wow, that person is pretty overweight. But then all of a sudden, you take off the fat suit. There's a little bit of a shock that is going to come to the markets here when they start to realize, oh, we don't have the United States government acting the way that they have been in the past. And to me, that is a really, really important element of this whole story here. And it's not just the tariffs. Now, moving back over here, this is kind of a side note, but this is where we start to talk about the real economy. Like I talked about a little bit before with this economic put that the White House might have to enact, basically providing a backstop for the economy there. When we look at real hourly compensation and what we were told it was in the third quarter of 2024 and what it actually was, I feel like a lot of people have heard this a couple of times that, oh, some of the economic data looks good, but why do all of these surveys show that people are still really feeling a lot of pain? And part of it is, honestly, if you were paying attention, a lot of the data was fake. We saw a lot of those significant downward revisions to the payroll numbers, and you're seeing yet another one here in the real hourly compensation. They said that wages were growing 1.6%, but they were actually down 0.1%. During that same time frame. So people are feeling the effects of these higher rates here and these higher prices. So when we think about the market here as a whole, guys, Tom Lee might be right in that the market will end up trending back to the upside. But we are going to need to see a couple of things starting to form in the market in order for that to actually happen. One, you need to see these large institutions starting to get more comfortable with the fact that the United States government is not going to be providing all of the support like it has been for the labor market and also for GDP. The other thing that we might end up seeing because of that is the Fed put coming back, where the Fed now starts to realize, because quite honestly, they were significantly behind the curve. If you guys remember one of the FOMC meeting minutes, I believe it came out in December, they cited the reasons why that they were so hawkish was because they were worried about the inflationary effects of tariffs. But they completely discounted all of these kind of deflationary elements of what was going to happen with this new administration here. So if that Fed put comes back and we start to see more rate cuts sooner, that definitely can ease economic conditions a little bit, and you can definitely see that capital flow back into the markets. But what I want you guys to realize here right now too is that it's too early. We still need to get through the first quarter of 2025. We need to see kind of the results of these tariffs because, again, even though I'm talking about this situation with tariffs as being not the big picture, they are still important because the market is reacting to all of the headlines coming out about them. But one of the most important things you need to start paying attention to is, again, the fact that the market really needs to come to terms with that the government is not going to be that crutch for the economy and the markets that it has been in the past. So I know we covered a lot in this video, guys. I might have gone on a little bit too long here, but if you guys did enjoy the information and analysis I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps me out a whole lot in spreading these videos out to as many people who actually want to learn. If you guys want to share this one with a friend, that'd be awesome. But yeah, I'll see you guys in the next one. Have a great rest of your evening. Peace.